Here is a statement that will upset a lot of people. Trading is not a skill. Not in the way the word is normally used. Not in the way that surgery is a skill, or chess is a skill, or playing the piano is a skill. And understanding why, really understanding it, might be the most important thing any trader can learn. What a skill actually is, before the argument, a definition. A skill is something that improves reliably with deliberate practice. A surgeon performs more operations and their outcomes get measurably better. A chess player studies more positions and their rating goes up. A tennis player hits 10,000 backhands and the backhand gets better. The researcher Anders Ericsson spent decades studying elite performance. What he found was that skill development requires one specific thing above everything else: a clear feedback loop. You do something, you see the consequence quickly, accurately, and without ambiguity. You adjust. You improve. He called environments where this is possible kind learning environments. Chess, surgery, sport. The feedback is honest. It tells you what actually happened. Trading is not a kind learning environment. Daniel Kahneman, Nobel Prize winner, the man who changed how the world thinks about human judgment, called it a wicked one. In a wicked learning environment, feedback is delayed, ambiguous, and corrupted by noise. And that changes everything. The feedback problem. Here is the core issue. In trading, a perfect decision can result in a loss. A terrible decision can result in a profit. The market does not grade your reasoning. It does not reward correct analysis. It moves for 10,000 reasons simultaneously, most of which no human can observe or account for. So when a trade closes green, what did you learn? That the setup works? That your analysis was right? Or that price happened to move in your direction this one time for reasons that had nothing to do with your entry? The feedback is corrupted. The signal and the noise are inseparable. And a learning system built on corrupted feedback does not produce skill. It produces superstition. This is why traders develop rituals. Lucky mugs. Trading only on certain days. Avoiding red shirts. The brain is trying to make sense of random outcomes by finding patterns. And patterns it will find, even where none exist. What the data says. This is not philosophy. This is in the numbers. Daniel Kahneman once analyzed 8 years of performance data from 25 professional investment advisors. These were educated, experienced people, paid significant money to apply their skill to markets. He looked for the simplest possible evidence of skill. Did advisors who performed well in 1 year tend to perform well the next? The correlation was 0.01, essentially zero. They might as well have been rolling dice. And yet, nobody in the firm knew this. Nobody had checked. They were celebrating and paying bonuses based on performance that was statistically indistinguishable from luck. The S&P SPIVA report, which tracks active fund managers against index funds, shows that over 15 years, roughly 90% of professional active managers underperform a simple index. These are people with teams, resources, research departments, Bloomberg terminals. If trading were a skill that improved with practice and expertise, the best practitioners should dominate. They don't. Brad Barber and Terence Odean studied everyday trader in Taiwan from 1992 to 2006. Less than 1% were consistently profitable year after year. Less than 1%. The rest were essentially funding the gains of a tiny cohort, and even within that cohort, persistence was weak. Nassim Taleb put it differently. Take 10,000 people, give them all a coin, and have them flip it every day. After 13 consecutive correct calls, one person will remain. Tell the world that person predicted the market 13 times in a row. Watch them get a book deal and a hedge fund. That person is not skilled. They are the statistical survivor of a large random distribution, and they are surrounded by 10,000 people who lost and were quietly forgotten. So, have any skilled traders ever existed? It is a fair question. And the honest answer is possibly, but not in the way most people imagine. Jesse Livermore is considered one of the greatest traders in history, made and lost fortunes. His timing of the 1929 crash is legendary. He made the equivalent of $100 million in a single year. He also went bankrupt 4 times. The pattern recognition was real. The risk management was not. He died with nothing. George Soros broke the Bank of England in 1992, making $1 billion in a single trade shorting the British pound. Is that skill? His framework of reflexivity, the idea that market participants' beliefs shape the very reality they are trying to predict, is genuinely sophisticated. But he would be the first to admit how much uncertainty sits inside every position he has ever taken. The one case that is hardest to argue against is Jim Simons. His medallion fund at Renaissance Technologies returned 66% per year on average for 30 years. That is not luck. That cannot be luck. But here is the critical detail. Simons was a mathematician, not a trader. His edge was pure quantitative pattern recognition applied to market data at scale. He explicitly said they do not look at news, earnings, or fundamentals. What he built was a mathematical model, and the skill was in building the model, not in reading the market. That is a different thing entirely. Where skill actually lives. So is there any skill in trading at all? Yes. But it is not where most traders look for it. The skill in trading is not in predicting price direction. It is not in reading candles or spotting patterns or knowing where price is going next. Anyone who tells you otherwise is selling something. The skill is in risk management, in knowing precisely how much to risk on every single trade before it opens and never deviating from that number. That is a learnable, improvable, measurable skill. The skill is in emotional regulation, in staying flat when the account is down, in not revenge trading, in not doubling up on a hunch. That is a psychological skill that can be trained. The skill is in process adherence, in building a system with a defined edge and following it with zero deviation, so that over hundreds of trades, the edge has enough room to express itself through the randomness. The traders who survive are not the ones who became better at predicting. They are the ones who became better at managing what they cannot predict. That is the real skill, and it has nothing to do with the chart. Closing trading is not a skill in the way the world defines the word. The feedback is too corrupted, the randomness too large, the survivorship bias too distorting for most of what passes as expertise to be real. But the process of trading, the risk, the discipline, the emotional control, the systematic thinking, that can be developed. That can be trained. That is what separates the 1% who persist from the 99 who do not. Stop trying to get better at reading the market. Start getting better at managing yourself inside it. At MarketIQBasics, that is what the work is really about. Subscribe for more honest trading content every week. See you in the next one.